So we'll discuss about the interest rate risk management. Interest rate risk can be managed using internal hedging methods such as matching and smoothing. It can also be managed through external hedging called as forward rate agreements, interest rate derivatives, futures, options, and swap. So we'll start from what is an matching. Matching is where liabilities and assets with a common interest rate are matched. For example, subsidiary A of a company might be investing in the money markets at LIBOR, and subsidiary B is borrowing through the same market at LIBOR. So there is an asset and there is a liability in the same company. So, and both of them are referenced to the LIBOR. So what happens? The asset cancels out the liability and hence it's like equally hedged. If LIBOR rate increases, subsidiary B's borrowing cost increases and subsidiary A's returns increase. So what happens is, if the interest rate is going to increase, the borrowing cost of B will increase and the income of A will increase. So both will compensate each other. The interest rates on assets and liabilities are therefore matched. So that is what is the matching concept is all about. So now we'll move on to the smoothing concept. Smoothing is where a company keeps a balance between its fixed rate and floating rate borrowing. So assume that you are a company and you want to borrow 100 crores. So what you do is you split it into 50 crores and 50 crore. The 150, the first part of the 50 crore you borrow it in fixed interest rate, and the other loan you borrow at a floating interest rate. Okay, so what happens is, even though the floating rises or falls, at least you are 50% you are happy. So 50% at least the rise and fall is matched. A rise in interest rate will make the floating rate loan more expensive, but this will be compensated by the less expensive fixed rate loan. So what happens is, if you're going to borrow all in the floating rate, again that's risky. If you borrow all the loan in fixed rate, again it's risky. So what you do is you have a combination of both. Company incur increased transaction and arrangement cost because of this. Because if you're going to borrow all the 100 crore loan in fixed, it's like one time you can do it. If you want to do it in floating also, you can do it one time. But if you want 50 crore in this arrangement and 50 crore in this arrangement, then you are going to raise the money twice. So that will lead to more transaction cost. Major companies with large amounts of borrowing may try to maintain a balance between the fixed rate and the floating rate. So that is about the smoothing concept. So we'll move on to the external hedging, which is called as a forward contract. A forward contract is a customized contract between two parties to buy or sell an asset at a specified future date. We will see the forward contract with an example. Assume there's a buyer and there's a seller. The buyer wants to buy gold. Okay, the price of gold today is at 3,000. The buyer feels the price can go to 3,500 and he wants to buy the gold, but not now, in 3 months time. So in 3 months he feels that the price might go to 3,500, but he says that I will buy the gold at 3,200, whatever the price is. Okay, whatever the price is, he will buy the gold at 3,200. On the other side, there's a seller who sells a contract. He feels the price of gold will not even be 3,100 in 3 months time. So he feels that there is a guy who is willing to buy the same gold at 3,200 rupees in 3 months time. So he feels he could easily make a profit of 100 through this transaction. So what is the essential difference is? The difference is the perspective, the buyer feels the price will go too high, the seller feels the price might not go too high, okay, or he might even feel the price can even go lower, okay. So only when there's a two different perspective, a contract usually gets created. The forward contract is fixed at 3200, okay. So that is about the contract. So on the third month, what would happen? The buyer will give 3200 rupees to the seller, and the seller will give the gold to the buyer. But who's profited through this transaction? It's not about the profit or loss about the transaction, it's about the fixing of the gold rate, okay, today, so that it would be like paid on the third month end, and the gold would be received irrespective of the market price. We'll have a computation like this. So we'll take the buyer and we'll take the seller. So we'll take it as inflow and outflow. The buyer has paid 3200 for an asset and the seller has received the same thing. So that is an inflow of cash. So that he gets 3200. If the market price of gold is 3500, okay, as per what the buyer thought, then how would the profit and loss would be? So the buyer gets the 3500 worth of goods. So that good he has paid only 3200, so he gets a profit. But the seller has to give this 3500 worth of gold, so he essentially makes 300 loss. So the profit or loss depends upon the market price. We can also change the market price and look at how this works. The market price, rather than rising from 3000 to 3500, it actually gone to 2800, so the price has fallen. Now let's see what happens to the case. So as promised, the 3200 will move from the buyer to the seller. But what would the seller give? The seller will only give 2800 worth of the gold. The gold would be transferred. That is the market price of the gold. That is what he will transfer. The buyer has actually paid too much. He has given 3200 to get a gold which is only 2800 worth. So he is going to lose around 400 rupees. And for the seller, like what he thought the price will move only from 3000 to 3100, but the price has actually gone to 2800. So the difference between these two will give him the profit, okay. So the profit or loss in the forward contract depends upon the forward price which has been fixed and the market price on the expiry of the contract. A forward contract can be used for hedging or speculation. Although it's non-standardized in nature, it is particularly apt for hedging. So the forward contract is not an exchange traded contract. It is just a contract between two people. So this is like very good or apt for hedging purpose, and the people can involved in hedging or even for speculation purpose. Forward contract can be customized because it is not an exchange traded contract. It can be customized for any commodity, amount or delivery date. Forward contract settlement can occur on cash or delivery basis. So we spoke as an example of gold. It is not the actual gold that has to be given from the seller to the buyer. It can also be the gold's worth. That is, gold would not be exchanged in hand. Even the worth of the gold, that is the 2800 rupees or the 3500 rupees, the worth of the gold can also be transferred. So it can be a cash based settlement or the delivery of gold based settlement. Forward contracts do not trade on a centralized exchange and are therefore regarded as over the counter instruments. So forward contracts do not trade in the centralized exchange. They are then called as over the counter instruments. So now we'll move on to the FRA. So FRA, forward rate arrangements, are an application of the forward contract to interest rate. FRA is a forward contract that fixes interest rate now for a future short-term lending, investing, or borrowing transaction. So an FRA is essentially a forward contract where the underlying is the interest rate. Okay, so the underlying interest rate is a very important concept here. If the actual interest rate at the date proves to be higher than the rate in the FRA, the bank pays the company the difference. So a company has bought an FRA, okay, FRA of 10% interest from a bank, okay, and this is for 3 months time, for 3 months duration. So what would happen here? See, the FRA is essentially 10%, and the actual interest rate at 3 months time, what happens is it has come to 15%. Then it means that the bank has to take care of the 5%, that is the bank has to pay 5% to the company. That means the effective interest for the company would be 10%. We'll put it like this: the company has made a bet. The bet is the interest rate will be like going up, so they feel that the FRA is 10%, but the interest rate in the 3 months time has actually gone up, so it means that they have made a profit. How much profit? The profit is 5%. So the 5% will move from the bank to the company. So effectively, if the company is going to borrow a loan, it doesn't need to pay 15%, it pays 15% as a loan, and it got the 5% benefit from the bank. So the effective interest rate is only 10%. We'll also look at the other case. For example, in another contract, the company has entered into a 10% FRA, it has bought, but the actual interest at the 3 month time is only 7%. Okay, so they have made a bet that the interest rate will go up, but it has actually gone down. So what happens here is they have made a loss, and that loss is a profit for the bank. Okay, that is a profit for the bank. The company has to now pay. If the company now borrows, they have to pay 7% as interest, they have to pay 3% as a loss to the bank. Put together you get the same 10%. Okay, so however you work, the interest rate will be the same. So whatever the FRA that has been fixed, that will be the effective interest rate here. So that is what is being explained here. If the actual interest rate at the date proves to be higher than the rate in the FRA, the bank will pay the difference. So that's what we saw just now. If the actual interest rate is lower than the FRA, the company pays the bank the difference. So that is what the arrangement is. If the interest rate goes up, the bank will pay the difference. If the interest rate falls, the company has to pay the difference. An advantage of FRA is that for the period of the FRA at least, they protect the borrower from adverse market interest rate movements to levels above the rate negotiated for the FRA. That means the rate that you have fixed in the FRA is what you essentially pay as an effective interest. So once you have taken an FRA, it is like booking in advance what is the interest that you want to pay. If you buy a 10% FRA, then it means your effective interest rate is 10%. If you buy a FRA for 12%, your effective interest rate is 12%. So that is about the FRA contracts. So we'll see the FRA payoffs. The bet is made on the interest rate, not the bond price. The long position in an FRA is the party that has already borrowed the money or is about to borrow the money. So we say that you buy an FRA when you feel the interest rate is going to go up. Okay, if you are a long position, it means you are buying the FRA. It means you are betting that interest rate will go up. That is your concept. So when the So you make a profit when interest rises and you make a loss when the interest falls. What is the short position? In the short position, you sell the FRA, that is in effect you bet that the interest will go down. Okay, how do you do that? For example, you have deposited in a FD. So the FD interest rate is 10%. You feel the interest will fall and it will come to something like 8%. You want to save this. Okay, you want to save the fall, the 2% fall. So what you do is you enter into an FRA, and the FRA is at 10%. So if you are selling the 10%, that means you are going to receive this 10%. And if the interest rate goes down by 8%, that is what you are buying. So this is the selling and this is the buying. If you net it out, you get 2% interest through the FRA. So you are essentially, you have sold it first and you are buying it later. You have sold it at 10, you are buying at 8. Okay, so you have made a profit of 2%. So the actual interest rate is how much now? The actual interest rate has fallen. So the FD will give you 8%, but the FRA profit is 2%. So put together, you have got the 10% interest. So that is your effective interest. Okay, so we'll repeat it again. The short position is used by a investor. The short position is used by the investor. The investor feels the interest rate is going to go down. So what he does is he sells an FRA at a higher interest rate, that is 10%, and he feels the interest rate will go down. So he buys at a lower interest rate. He makes a profit of 2%. The actual FD deposit has also gone to the market interest rate of 8%. So he has made a loss in the FD. So his interest rate has only become 8%, but he has made a profit in the FRA. So that is 2%, and totally he now will get 10% as his interest income. So in the short position, if the interest falls, just like our example, the company will make a profit. But if interest rises, then the company will make a loss. So that's about the payoff in FRA. So FRAs are arranged with the bank as an OTC transaction. An FRA is not an arrangement to lend or borrow. That is not the concept. FRA is an agreement or a bet made on the interest rate. It is an agreement that fixes an interest rate on a notional amount of principal. So what is a notional amount? There is no transfer of loan amount or investment amount. Only the bet is made on the interest rate, and any gain made on the movement of the interest rate is like paid. One limitation of FRA is that they are usually available on loan of at least 500,000 pounds. They are also likely to be difficult to obtain for periods of more than 1 year. So FRAs are essentially a medium term instrument. So we'll see the terminologies involved in FRA. If they give you a parity like 5.75 to 5.7, it means that you can borrow at 5.75 and you can invest at 5.7. So you always, if you want to borrow, the borrowing rate is higher than the investing rate. This is the same parity that also happens in a bank deposit and borrowing. If you go to a bank, the FD will be 6%, but if you want a loan, that will be 12%. So always the borrowing cost will always be higher than the investing income. So they also say that a 3-6 forward, a 3-6 FRA, a 3-6 FRA is an agreement that fixes an interest rate for a period starting in 3 months time and lasting for 3 months time at the end of 6 months. So we'll see an example for this. Similarly, a 312 FRA fixes the interest rate for a 9-month period starting from the 3rd month. See the first number, for example, we say 312 FRA. Here it refers the contract will start in the 3rd month. Okay, So assume the year is in January. In 1st April, the contract will start. Okay. And the total period of FRA, it is a 12-month FRA. That means it starts in April and it runs for a period from the 1st Jan. It runs for 12-month period. That is, it ends in 31st December. Okay. So essentially, it is only a 9-month contract. It is essentially a 9-month contract. Okay. So we'll also do for this 3/6 forward. If you take a 3/6 forward, it means if it's going to be January 1st, January today, the contract is going to start in the 3rd month and it will run from the 3rd month to the 6th month. So that is what the FRA means. So the contract will start on the 3rd month, means like January, February, March is over. So it will start in 1st April. And from April, May, June. So up to 30th June, the contract will run. So essentially, this is for a period of 3 months only. Okay. So you can just, so the first number indicates the starting of the FRA period. Okay. And the ending number tells the month in which the FRA gets over. So we'll have a quiz now. A company treasurer needs to borrow 10 million euro for 180 days, 60 days from now. The type of FRA and the position he should take to hedge the interest rate risk on this transaction. So the company wants to borrow a 10 million euro. That means it is a long, they're trying to go for a long position. Okay. And the loan is going to start in 60 days. It means in 2 months time it's going to start and it's going to run, and the loan is for a period of 6 months. So the entire FRA is for 6 months. Okay. So from the 1st month into the 8th month, the FRA would be the life. So it starts in 2nd month, it will run up to the 8th month. It is a 6 months of duration of FRA. So 2 into 8 long position is what the answer is. The answer should be B. So we'll move on to the next one. It's called as interest rate derivatives. Interest rate derivatives can be used to hedge against the risk of interest rate changes. They include interest rate futures, interest rate options, and interest rate swaps. So we look at what is a futures contract. A futures contract differs from a forward contract in the following ways. The transaction in forward is an overtrade contract. In futures, it's an exchange contract. In terms of counterparty risk, there is more counterparty risk in forwards as it's an over the trade counter. No such risk exists in futures. In the nature of contract, the forwards are customer visible because it is only between the parties. But in futures, the nature of contract is fixed or it's a standardized contract. The size of contract also depends upon parties in forward contract. In futures, it's fixed. Maturity, it depends upon the parties in forward. In futures, again, it is fixed and standardized. Settlement is usually done only on the date of maturity, but in futures, it is like daily settled. Okay, so that is what we call as a mark to market settlement. Variation here, there is no margin or anything which is involved upfront, but in futures, there is a upfront margin and also a maintenance margin. The valuation, there is no valuation required in forward contract. In future contract, there is a mark to market settlement on a everyday basis. So we'll have a quiz. Which of the following most accurately describes a derivative security? A derivative always increases risk. No. Has no expiration date. Again, that is a wrong thing. Has a payoff based on a other asset. So that is the right. That is the name of a derivative. It derives a value from another asset. So answer C should be the answer. Yes. So we have another quiz. Which of the following statements about exchange traded derivatives is least accurate? So which of them is wrong? That's what he wants. They are liquid, Yes, because as there's a market, everyday settlement happens. So this is a correct option. They are a standardized contract. Yes, again, this is also a correct option. They carry significant default risk. This is a wrong option because default risk happens only in a OTC market, that is for a forward kind of contracts. So this is wrong, and they are asking which of the following is wrong. So C is the answer. Option C is the answer here. So we'll move on to what is the interest rate futures. Interest rate futures are similar in effect to FRAs, except that the terms, amounts, and periods are standardized. So it is an FRA, but it is like traded in the market. Short-term interest rate futures contracts normally represent interest receivable or payable on notional lending or borrowing. So it is only notional. There is no full amount of loan or investment which is transferred, and only on a notional amount the future interest rate is calculated for a 3-month period beginning on a standard future date. So in interest rate futures, everything is like standardized. The contract size depends on the currency in which the lending or borrowing takes place. For example, a 3-month sterling interest rate futures March contract represents the interest on notional lending or borrowing of £500,000 for 3 months starting at the end of March, and 500,000 is the contract size. So if you see here, everything is like standardized. The contract is a 3-month contract. It is a sterling contract. It is an interest rate futures contract. The contract is going to end in the month of March, and it can be on lending or borrowing. The amount is also like mentioned here. So it is being like mentioned everything in a particular specific way. So that is what an interest rate futures is. In forward contracts, all these specifications can be changed. As with all futures, a whole number of contracts must be dealt. Note that the notional period of lending or borrowing starts when the contract expires at the end of March. The problem with the futures is, assume that you want to hedge something like 800,000, but the contract is available only for 500,000. So the problem is, you can either buy a one contract for 500,000, or you can take another contract for 1 million, but you can never take a contract for 800,000. Okay, so that is a problem with futures, because if you take 500,000 contract, you cannot hedge for the balance 300,000. If you take a 1 million hedging, then you are like over hedging your position with 200,000. So there is always a under or over hedging problem with the interest rate futures. In forwards, you can create any contract as per the amount that you want. That's why forward contracts are very famous when compared to futures contract. Futures contracts are available with maturity dates at the end of March, June, September, and December. So these are the ending or maturity dates for a futures contract, and they are also fixed. The standardized nature of interest rate futures is a limitation on their use by the corporate treasurers as a means of hedging, because they cannot always be matched with specific interest rate exposures. So there are some drawbacks in terms of interest rate futures, and that is why corporate treasurers don't prefer interest rate futures. In this slide, we look at how interest rate futures work. Interest rate futures do not move with interest as FRA does, because interest rate futures is based on the bond price and not the interest. Price and yield are always inverse in nature. If interest rates rise, the bond's price will fall, and vice versa. Borrowers will wish to hedge against an interest rate rise by selling the futures. That is, If the company has borrowed at a 10% interest, then the bond price would be 100, and they feel that the interest rate might go up and they want to hedge it. How do they hedge in IRF is they try to sell the future. Why? Because if the interest rate goes up, okay, that is what they thought. If the interest rate goes up, the price of the bond actually falls down. Okay, and the interest rate futures are priced based on the rate of the bond and not the interest. So if the company wants to borrow, okay, or if the company has already borrowed and they want to hedge their interest rate, that is they are feeling that the interest rate will go up, then the company has to sell the futures. The reason is the current interest of 10% will give the market rate of 100, and if they feel the interest rate is going to go up to 15%, the price of the bond will fall. As the IRF is like mentioned in terms of the bond price, they have to go in for selling the futures. So the company has already sold the futures at 100 rupees, and the interest rate has gone up and the bond price has fallen, and now the company can buy the bond. So they have essentially sold it before and they are now buying it, so their company will make a profit of some amount. So that is how interest rate futures work. So assume that you are a lender or an investor in a bond, and you feel that the interest rate might fall down. So what you should do, you feel that the interest rate will fall down, so what you should do is you have to buy the futures. So currently the future is interest is 10% and the price of the bonds are 100. So essentially you first try to buy the bond. So the buying the bond is 100 rupees. So after a particular point of time, the interest would go down, like actually how you thought. So when the interest rate goes down, the the bond price will go up. So at that point of time, the company can sell it. So essentially, they can make a profit. Okay. So you always have to think in vice versa. So borrowers sell futures and investors or lenders buy futures. They go in for buying futures. Okay, so that's how they are related. So we'll have a quiz. Which of the following statements are correct? Interest rate options allow the buyer to take advantage of favorable market movements. Yes. If you want, you can exercise the option. If you don't want, you can allow it to expire. An FRA does not allow a borrower to benefit from a decrease in interest rate. That is also true. Irrespective of what is the interest rate, you have to pay the interest rate fixed by the FRA that you have to pay. Borrowers hedging against an interest rate increase will buy interest rate futures now. No, borrowers sell sell interest rate futures. So that's what we saw. So this is wrong. So 1 and 2 are correct. So A should be the answer. The answer is A. So we'll move on to the next topic. It's called as options. A currency option is a right of an option holder to buy or call, sell or put a quantity of one currency in exchange for another at a specific exchange rate. The excise rate, the excise price, the strike price on or before a future expiry date. So we'll start from what is a call option. A call option is an option to buy an asset at a particular price. It is termed as a call option. The seller of the call option has an obligation to sell the asset at the agreed upon price if the call buyer chooses to exercise the right to buy an asset. We'll see how this works in terms of a interest rate. Assume that you are a borrower and you feel that interest rate will rise, that is it is currently at 10% and you feel it will go to 15%. So you could have used an FRA, or you could have used an interest rate future, or you can go for an option. So what you have done is you have chosen an option. So what is an option here? In option, you are going to buy a call option. Okay, you're going to buy a call option. That is, you feel that the interest rate is going to rise. That's why you are buying a call option. So you feel it goes to from 10% to 15%. So the call option works like this. You have to pay a option premium. You have to pay an option premium. That is to enter into the contract. You have to pay this. And once you have got paid the premium, you have the right. What right you have? You have the to receive right to receive interest above 10%. Okay, so if the interest rate goes to 15, then you will get the 5% will be like received by you. If the interest rate goes to 12% in 3 months time, you will receive the 2% balance. So you have the right to receive interest above 3 months 10%, and this is in 3 months time. Okay, this is a 3 months concept. So on the third month, okay, on the third month, the interest is 14%. Okay, the interest has come to 14%. See, if you're going to borrow now, you have to pay an effective interest of 14%. But as you have taken options, okay, you have taken options. Now you have to pay 14%, but from the option you will get how much? From the option you will get anything above 10%. So anything above 10% is 14 minus 10, you will get 4% as income or profit from the options contract. If you go and borrow at interest rate, you have to pay 14%. So if you deduct both, if you deduct it, effective interest for you is only 10%. Okay, how does this occur? Because from the options you have got the right to receive more than the 10%. So as the interest rate is 14, you got the balance of 4%. That is a profit for you. And as the market interest rate, you have to pay 14% if you're going to borrow. That is an outflow. So outflow of 14 and inflow of 4 will give you 10%. So that's how it works. Look at other cases also. For example, if the rate has not gone to 10%, more than 10%, but it has gone to something like 8%. Okay. In the options contract, you have the right to receive anything above 10, but it's only 8% is the interest rate, so you won't get anything. In that case, you will allow the option to expire. That is, you don't pay anything and you won't receive anything. You have essentially got nothing. So now your effective interest is 8%. Okay? So it works like this. I want to draw diagrammatically, we can draw like this. You will maximum pay only 10% as the interest rate. If it falls, you get the benefit also. If it falls to 8%, you are eligible for the benefit. That is how the options work. So your maximum is always capped at 10%, but you are allowed to enjoy like how much ever the fall is in the interest rate. See, this is not possible in FRA or in interest rate futures, because there you have made a commitment to pay 10% always. So if that's going to be if you're going to make any gain, you can't get it, because if the interest rate falls by 8%, then you have to pay the balance 2% to the bank, and the interest rate will come to the same 10%. If the interest rate goes to 12%, the bank gives you the 2%, and your interest rate again comes to 10%. FRA and in IRF, the interest rate is always at the entered one, the 10%. But in options, you have the option to pay 10. If it's like favorable to you, you can take an advantage. If it's adverse to you, you don't take that. Okay. So anything favorable, you can take an advantage of it. We'll discuss about the put option. An option to sell an asset at a particular price is termed as put option. The seller of the put option has an obligation to purchase the asset at the agreed upon price. If the put buyer chooses to exercise the right to sell the asset. So we'll also see how the put option works. See, if you are an investor and you are getting around some 10% as the interest, and you feel the interest will fall, to something like 5%. So that is a bad situation. So what you will do is you will try to buy a put option, the right to receive any interest below 10%. So if the interest goes below 10%, then the option holder has the right to receive the interest. Okay. So this is for a period of 3 months. Okay. So in the third month time, what happens is the market interest rate comes to something like 7%. Okay. So the company will be like receiving 7% from the market because they are an investor and they've already invested at a variable rate. They have already invested 10%, but the current market rate in the 3 months time it is 7%. So they are incurring a loss. But they have an option. As the option is now favorable for them, what they will do is they will excise their option and they will receive the difference. So what is the difference? As per the contract, they have the right to receive any interest below the 10%. So anything below the 10% is 10 minus 7. So they will receive 3%. So they have made a profit. So totally they have got again the 10% as the interest. So the hedge has worked perfectly for them. But we will also look at a case where things are not like that. Example, the market interest rate rather than going down, it has gone up and it has gone to 13%. Okay, 13%. Now, will they receive the difference? No. The option is, as it has gone against them, what they will do is they will allow the option to expire. So still they will get 13%. So again, if you draw a chart, it works like this. The company will always receive 10%. If it's going to be a higher number, they will receive that number. Okay. But in IRF or FRA case, they will be receiving the same 10. So this profitable part, okay, this profitable part is available only with the option. Okay. But the drawback of option is to enter into this contract, the company has to pay option premium. Okay. So that is about the options contract, put option. So interest rate options allow an organization to limit its exposure to adverse interest rate movements while allowing it to take advantage of favorable interest rate movements. Okay. So that's what both the charts will tell you. So if you take a call option chart or you take a put option chart, okay, if this company has taken a call option will be taken by a borrower and a put option will be taken by a investor. Okay. So for a borrower, if the interest rate goes like this, okay, and if it falls, he will take advantages of this also. He has the ability to take an advantage of this. So if the 10% goes down by 8%, he will take an advantage of this. For an investor, if he is going to receive 10% always, and if the interest rate goes up to 12, he takes an advantage of this also. Okay. But why is it like so important? It's important because in a IRF or a FRA, okay, they cannot take the advantage. This favorable movement advantage they cannot take. Okay. So here also they cannot take the favorable movement advantage. So that is the problem, and that is the benefit what options give you. So options is the one which gives you to limit the exposure to adverse interest rate movement, at the same time to take advantage of favorable interest rate movements. This is a very important topic from the exam point of view. Try to ensure to understand this. Interest rate options are linked to reference rates such as LIBOR or EURIBOR. An interest rate option grants the buyer of it the right but not the obligation to deal at an agreed interest rate. So it gives you an option. The interest rate option grants the buyer the right to buy the asset. On the date of expiry of the option, the buyer must decide whether or not to exercise the option. Tailor-made OTC interest rate options can be purchased from major banks with specific values, maturity period, denominated currency, and rates of agreed interest. The cost of the option is the premium. Interest rate options offer more flexibility than and are more expensive than the FRAs. So again, this is a very important point. So options are costlier than the FRAs because for that you have to pay a premium. Clearly, a long or buyer of an option is an option to borrow will not wish to exercise it if the interest rate is now below than specified in the option agreement. If the interest rate specified in the option agreement is 10% and the market interest rate is 12%, the option buyer will exercise his right. If the market interest rate is 8%, the option buyer will allow the option to lapse. Conversely, a short or seller of an option is an option to lend will not be worth exercising if the market rates have risen above the rate specified in the option by the time the option has expired. If the interest rate specified in the option agreement is 10% and the market rate interest rate is 8%, the option buyer will exercise his right. If the market interest rate is 12%, the option buyer will allow the option to lapse. So now we look at the interest rate cap and floors. An interest rate cap is an option which sets an interest rate ceiling. A floor is an option which sets the lower limit to interest rates. Using a collar arrangement, the borrower can buy an interest rate cap at the same time sell an interest rate floor. This limits the cost of the company as it receives a premium for the option sold. So we look at a picture. So assume that a company's interest rate keeps on fluctuating. So they feel that they want to have it within a range of 5% to 2%. So what they do is they don't want to take any risk more than 5% and they don't want to pay anything which is less than 2%. So they want a range between 2 to 5% as their interest rate. They are very comfortable with this position. So what they do is they go for an option. They buy a call option. So what happens is they pay a premium. They pay premium for this. Okay. So whenever it goes above 5, the other company will pay money to this company. So assume the interest rate is 6%. The company will receive 1% as their income. Okay. So even it is 6%, even when the interest is 6%, the income will be like 1% from the other company. It is because the option will be exercised and the company will pay effectively only 5%. But at the same time, what happens is they don't want they want to restrict themselves with interest rate of 2%. So what they can do is they can sell a call option again. They can sell a call option. For this, they will receive premium. So what happens here is if the interest rate goes to 1%, okay, if the interest rate goes to 1%, the company has to pay another 1% to another company. So the company will pay, the company's effective interest is the current market interest they have to pay, that is 1%. Okay, the option premium will be excised by the other company, so they will ask another 1%. So that comes to another percent. So that comes to a total of 2%. So that is effectively what is the range they wanted. The range was 5 to 2%. So interest rate caps, collars and floors is what this. So the above thing is called as the cap, the lower end is called as the floor, and put together is this 2 to 5 is called as the collar. So 5 is the cap, 2 is the floor, 2 to 5 is the collar. Okay, hope you have understood this. We'll go to the next point. So the cost of a collar is lower than buying a option alone. However, the borrowing company forgoes the benefit of movements in interest rates below the floor limit in exchange for this cost reduction, and an investing company forgoes the benefit of movements in interest rates above the cap level. So that is the drawback of a interest rate collar. Our overall premium is lower because we are also going to receive a premium. So our overall premium is low, but for that lower premium, we are sacrificing a benefit. Okay, the benefit is 5% to 2%. So this is what we are sacrificing. Okay, we have to pay always 2%, but we are going to reduce a premium because for this we have received a premium. So our premium is an income here, or a premium is a outflow here. So put together, if we put, our premium would be actually a little bit lower than a normal premium alone. That is what they are mentioning it here. A zero cost collar can even be negotiated sometimes if the premium paid for buying the cap equals the premium received for selling the floor. So when the premium to be paid and the premium to be received are equal, we can also create a zero cost collar. So we'll move on to the swap, interest rate swap. So interest rate swaps are where two parties agree to exchange interest rate payments. It is not done through exchanges, hence it is a counterparty risk involved. Interest rate swaps can act as a mere means of switching from paying one type of interest to another, raising less expensive loans or securing better deposit rates. Assuming that the interest rate swapped is in the same currency, the most common motivation for the swap is to switch from paying a floating rate interest to a fixed rate interest. So the normal kind of a swap is done for interest rates is in terms of converting a fixed rate loan to a floating rate loan. So this is known as the plain vanilla swap. So we'll see it in through an example. So we can have it like this. So company A has borrowed a fixed interest rate loan and company B has borrowed a floating rate loan. But after raising only, they have found that this to be not a good kind of a loan. But they can't close this loan because usually this would have been raised through a bond for 7 years. Okay, and again this would have been for a debenture of 7 years. So they cannot like quickly close this and all. So what they have to do is they have to have this bond and pay a fixed rate, but still this company feels they want to pay a floating rate. This company is paying a floating rate, but they want a fixed rate. So what can they do is they can mutually exchange. So company A wants to pay a floating rate, so they pay the floating rate to company B. Company B, which is already paying a floating, they want to pay a fixed rate, so they pay the fixed rate to A. So both are happy. This fixed rate which is received by A is like quickly transferred to the bonds, and this floating rate that was received by company B is quickly transferred to the debenture. So both companies have made their debenture holder and bond holder happy. At the same time, they have also exchanged their interest rate pattern. Okay, so it's very simple like this. This loan interest is paid by this company and this loan interest is paid by this company. So they have altered their interest pattern. So we'll see an example here. So here you can see that over a period of every 6 months, the interest is getting swapped. In interest swapped, the capital is not swapped. Okay, the capital is not swapped. Only the interest part is swapped, and even the interest part, only the interest difference is swapped. Okay, only the interest difference swapped. For example, this company pays a fixed coupon of 6,200. This company pays a floating of 3,300. So this goes to this company and this goes to this company. So will they transfer this full amount? The answer is no. Only the differential, okay, the difference between the two are getting transferred. this company, we'll take it as company A and company B. Company A has to make a payment of 2,893 from A to B. Again, there's a minus symbol. So again, A will pay to B. Okay, again, A will pay to B. A pays to B. A pays to B, and again A pays to B. Only in the last scenario, the B pays to A. Okay, so only the net amount is like transferred and not the whole amount. So capital is not at all transferred. Interest is calculated, but only the interest differential is transferred. This is a very important point of swap. So if you see, the net interest differential is what is being transferred from one company to another company. So we'll have a quiz. In a plain vanilla interest rate swap, the notional principal is swapped. Is it true? There's no interest swapped at all. So this is wrong. Only the net interest payments are made. This is right. The notional principal is returned at the end of the swap. No. So answer should be, the answer is B. So we have another quiz. Which of the following statement is least likely an advantage of swap? So which of the following is not an advantage? Have little or no regulation. Yes, that is a advantage of swap. Minimized default risk. No, it is a over the counter transaction. So it has a high amount of risk. Have customized contracts. Yes, it is a over the trade contract. So it is can be customized. So the disadvantage is B. So the answer should be B. The answer is B. So questions from the past exams. In the past exam, these questions were asked in section C also, but going forward, you will have these questions only in section A and B. So you'll have like problems, you will have like theory questions. So this is a very important part of section A and B. So ensure that you understand this part of the syllabus also. So thank you very much for watching. We'll meet in the next video.